Hi everyone and welcome to this very exciting video. So this video is a masterclass about investing in your early 20s. So let's say you're in your early 20s, just started working and are planning to do certain things like having some emergency funds, planning for some travel, then planning for, let's say, your first down payment, and you should also start thinking about your retirement early on. So this video will tackle all of these sections and help you guide your investments in the most efficient way. So see you in the class. Hi everyone and welcome to this very exciting class. So we are going to talk about how to invest or manage money in your 20s. So let's start with it. So what are the assumptions that I'm making in this video? So there are certain assumptions like you're in your 20s, you are recently graduated, so just started to work, you have some student loans, you have that is your primary debt, you have very low to no savings because you have just started working and currently you are renting. Okay. So what are the important or goals people have in their early 20s? So the goals that people have, and you should, if you don't have one, you should start thinking about all of these. These are common goals that people have. The first one is having some emergency funds. Emergency funds are very important, okay? Because in life shit happens and you need to have some funds to deal with that, right? All your goals, all your financial situation could be at risk if you do not have some funds allocated for emergencies. So it's very important to have emergency funds. Then you should have some monies, like you should start thinking about like buying your first house, right? The earlier you start, the better it is because it gives you more time to plan for it. And when you're renting, you're paying someone else's mortgage, so it's a good strategy, right, to start building up some equity, right, that you can use to purchase your first house. Then travel is the other common goal that most people in their early 20s have. So how should you approach travel? How should you think about travel? And finally, a goal that is very important to think early on is your retirement and financial independence. So we'll talk about all of these common goals, how you should approach them, how should you tackle the challenges that these goals throw at you. Okay. So first is emergency fund. So most financial planners recommend that you should have at least 3 to 6 months of living expenses with you in emergency funds. Now emergencies could be anything. It could be a medical emergency, it could be your car breaking down, it could be you need money at like necessity when you're traveling because something happens when you're traveling. So all these are emergencies that you should have some funds for. Okay. And you should, along with emergency funds, have a comprehensive insurance strategy. So I'll create another video for insurance planning in your 20s. So you should think about disability, you should think about travel insurance whenever you're traveling, you should start thinking about other insurance like car insurance and stuff, right, and how to save money and how to approach it in the right way. We'll talk about it in another video. But this is the pyramid, this is the mental model that I personally use to save up for my emergency needs. So there are different like types of investments that you can use. You can accumulate emergency funds in savings account, you can accumulate in money market ETFs, lines of credits and credit cards. So let's go one by one on what these accounts are and how can you use them to accumulate your emergency funds. Okay. So first is savings account. What is a savings account? You can open it with any online firm like Tangerine or Neo Financials, or you can open it with different banks. So savings account generally generates compound interest. So whatever amount you're putting in a savings account, that generates interest. It gets added into the savings account and then it compounds from there. So there is interest on interest that is generated in a savings account. Savings account most of the time have very low interest rates, right? Personally, my strategy is whatever is my emergency fund, we'll see in Google Sheet to calculate that. But whatever is my emergency fund, 33%, one third of that, I want to accumulate in my savings account. Savings account are very easy to access. You can transfer money right away, right? And you can use it in case of emergencies. So it's a good idea to have, like my strategy is to have 33% of my emergency funds in a savings account. Now, in Canada, there are different options that you can use. So I'll show you some options that you can use for savings. Okay, so TD savings account. So TD is a bank. So you can open savings accounts with different banks. So example will be personal savings account in TD. Okay, so you can open it online, right? There is 0 monthly fees, there is interest rate, right? And you can start saving into it. Very easy to open, and you start saving. So if you view details on it, so there are savings account have transaction fees, and this account doesn't have any monthly fees. So that's important to note, that you have to limit your transactions in savings account. Just put your money there and don't use it unless you absolutely need it. It's not like check-in account. Okay, so browse interest rates. Let's see in TD. So this is the interest rate that TD has. So very low interest rates initially, little bit higher as you go up. So this is an example of a traditional bank in Canada savings account that you can open. You can also open it with fintech firms like Neo Financials that give little bit better interest rates. Okay, so I'll show you an example. So it is giving you 2.25% interest rate on your savings account. So higher than like traditional banks. So it's your call where to start saving. Okay. Next is a money market ETF. So what a money market ETF? So it's like a mutual fund. You hand over your money to a manager to manage, and on behalf of you, they make investments, right? This is the concept of mutual fund. Money market ETFs are ETFs or funds that invest your money in short-term interest-bearing instruments. So they do not take risk on your money. They invest it in, let's say, financial institutions. They open savings account there. They bargain with them, get higher interest rate, which they pass on to you, or they invest in like Government of Canada treasury bills and stuff. So the risk is very low in a money market mutual fund. So you can put your money market mutual fund, or you can add that ETF in your tax-free savings account, registered retirement savings plan, RESPs, or your first housing savings account, right? So they can be added into registered accounts. The important point is money market ETFs have better interest rates than savings account. Okay, so savings account was giving 2.25%. Money market ETFs might give you higher interest rate than that. But it's important to know, when you are investing in a money market ETF, when you want to have access to that money, you have to sell that ETF when the stock markets are open, and then withdraw. You will get money in T+2 days, right? So it's important to understand that you need some lag. If you have an emergency, you don't get the money right away. So higher interest rates, that's a positive, right? But not as liquid as savings account. That is the negative part of it. My strategy is, after having some funds in my savings account, the top up of that emergency funds, I have it in my money market ETF, so that if something happens, right, I have access to it, not right away, but I do get better interest rates than savings account. Now I'll show you an example for it. So example will be something like cash.to. So this is an example of a money market ETF. So Horizon's high interest savings account. So what do they do? So if you see product facts, they seeks to maximize monthly income. So they pay monthly interest. The yearly interest is 4.29%. They divide it by 12 and pay you monthly. So you get some monthly amounts. But what these guys do, they invest your money, right, with Canadian banks, right, in high interest deposit accounts. But since they're investing large amount of money, they can bargain better. So if you see the interest rate on this, it is 4.29%, which is way higher than your savings account interest rate. So after having some allocation to savings account, right, then you can start building your emergency fund in a money market ETF, right? You don't get access to money right away. You have some lags, but you have better interest rates than a savings account. So this is an example of a money market ETF. You can buy it by opening a investment account with, let's say, Wealthsimple or with any Canadian broking firms like TD or RBC, and you can add it in your tax-free savings account so that all the interest is tax-free. Okay, my personal strategy, I fill my savings account first, and after that whatever is extra, right, I try to accumulate that in a money market ETF. Then you can also use lines of credits to borrow money, right? So lines of credit is you approach a financial institution, they check your credit ratings, they check your like debt flows and stuff, how much money you're making, how much debt you're paying, all that they check, and based on that they will approve a like dollar amount that you can use, right, whenever you want. If you use money from that approved amount, you pay interest. If you do not use money, you do not pay interest. Now, lines of credits in Canada are secured lines of credit. It means you're securing it against something. Maybe you have a house, you're securing it against it, or you have investments, you're securing it against it. So the interest rate is lower. Or it could be unsecured, right, in which you're not having some assets, you're just basing the line of credit on your personal credit rating. So in that case, the interest rates will be higher. Important point, lines of credit have a lower interest rates than credit cards. So in case of utter emergency, rather than taking cash or using credit cards too much, it is better to use lines of credit. So my strategy is to use lines of credit as the last resort, right, for my emergencies. You can also use credit card for emergencies, but it is not recommended. Interest rates are very high. The interest rates right now on credit cards are 22% and beyond, right? So very expensive. Plus, whenever you withdraw cash on credit cards for emergencies, they will charge you something called as cash advance fees. These are on top of the interest that they charge you. So it's a very expensive proposition to use credit cards for emergencies. Now, let's look at a Google Sheet and let's plan a sample case, and you can then use this Google Sheet for yourself to plan your emergency fund. Okay, so let me go to that Google Sheet. So this is a Google Sheet that I'm going to share in the description, so you can use it. So how to use this Excel sheet? So first step, put in your monthly expenses. So I am saying that my monthly expenses are $4,000 all in. Okay. Financial planners recommend 3 to 6 months of living expenses in emergency funds. I am taking 6, but you can take 3 or whatever number you want. So that will give you a total amount, right, you have to accumulate. So if your monthly expenses are $4,000, then you need to accumulate $24,000 in your, say, like in your emergency funds. Now, this is the strategy that I use. 33% of this I try to accumulate in my savings account. 50% of this I try to keep in money market funds, and the rest of it I use lines of credit to defend myself against emergencies. So dollar amount, 33% of 24,000 will be 7,200, 7,920. $12,000 will be 50%, and 4,080 will be something that I might use from lines of credit. Now let's say you might not have enough money to accumulate emergency savings right away. So let's say you are giving yourself a 3 years target to accumulate emergency savings. Okay, so 3 years target, so it is 36 months. Lines of credits you can get approved right away, so don't need time to be involved, so time would be 0, and you should get approved for some line of credit as your last defense against emergencies. But let's say I want to accumulate this amount in 36 months, this amount in 36 months, and interest rates, I'm just taking the interest rates right now. So interest rate is 2%, or let's put in 2.25%. That's what we were getting on Neo Financials. So let's use that. I'm just expanding it. And 4.29% is money market interest rate. So one-time investment, if you have any, let's say you have $200 right now, $100 you keep in savings, $100 you keep in money market funds. So this calculator will calculate how much monthly you need to save, right, for emergencies. So $209 in your savings account and $308, right, in your money market fund. Now, once you build this money market fund, once you have enough savings for emergencies, then you start planning for everything else. Step number 1, priority number 1 is always to plan emergencies, right? Things can happen, things can go wrong, and you need to safeguard yourself before even thinking about other financial goals. So priority number 1, take it onto yourself to plan for emergencies. You can use savings account, money market fund, combinations of both, right, and accumulate that amount in your account. Once you have it, you will have peace of mind. So let's say I have $24,000 that I can access. Now I have peace of mind to achieve other things in my life. So that is step number 1. Then a second goal that you could have and you should start thinking about is to purchase your own house. Because when you're renting, you're not building any home equity. So you're paying someone else's mortgage. Rent is an expense that you do not get back. But when you buy your own house and you start paying mortgage, right, you are building your own home equity. So whatever mortgage you pay, the principal amount you pay, you start saving up in your house, right? Now, before taking on mortgage in your early 20s, you should have some goal of getting to a decent amount of down payment. Now you can ask me these questions and I'll answer them one by one. How much you should accumulate in down payment? So minimum down payment you require is 5%, but I would highly recommend to get as high as down payment as possible. A good ratio is 20% down payment, because when you accumulate 20% or more, then you save on CMHC insurance. CMHC insurance you have to pay if your down payment is less than 20%. So if you accumulate more than 20% down payment of your house value, then you save on your CMHC insurance. You do not have to pay for it. The housing I have covered in details in different videos. I will link all those videos below, right, in the description. Now, where should you accumulate this down payment? The best account to use, best investment account to use is right now First Housing Savings Account. This account will be launched in 2023. It's a very interesting account that is a combination of tax-free savings and RRSPs. So it has an 8,000 per year limit. Whatever investments you accumulate in this, they grow tax-free, and whatever amount you put in First Housing Savings Account, that gives you a tax deduction. Again, I have covered First Housing Savings Account in very great details. I will link the video, right, for that in the description. Now, where should you put your money to work? What should you add in your First Housing Savings Account? The best way is money market ETF, because you don't want to take risk on your down payment for your house. You don't want to get exposed to stock market or bond markets and the whimsical ups and downs that they show. It's a very good idea to invest in a low risk instrument like a money market ETF, pays you some interest, has high liquidity, you can save, sell those funds right away and get money, and it has decent interest rates. Not too low as savings account, but not very high, right, as some bond or preferred funds. Okay, so this is like a strategy that you can work, right? Try to accumulate 20%, use First Housing Savings Account, and try to use money market ETF like cash.to to build on that corpus. So we'll see a Google Sheet calculation. Again, you can use this Google Sheet for your own purpose and own financial plan. Okay, so let's go to the housing one. Okay, so I've given you some sample calculation and I'll explain first housing savings account with that. So let's say you want to buy a 350,000 apartment. It is a starter home for you. You want to buy that apartment. Minimum down payment you need is 5%. I'm going with 5% because it might be too hard for you to accumulate 20% in your first house, but you should try to accumulate as much as you can. Then down payment 5% of 350,000 will be 17.5, right? 17k as 17.5k as your down payment. Let's say you want to accumulate this in 3 months because you do not want to pay rent for a long period of time. So you are giving yourself 36 months, right? Is 3 years to accumulate that corpus. Interest rate is 5.25%, let's say on a cash.to kind of instrument. So I have inputted that interest rates. You have $500 right now with you to start your investing journey. So you put $500 in a first housing savings account, right? And you're going to get 4.25% interest. So this calculator will actually calculate, okay, how much you need to accumulate 17,500. So you need $440 per month, right, to accumulate $17,500 in 36 months. So you start putting that, you start accumulating, you get some interest on it. It's a safe investment. Don't want to take too much risk. Now, the interesting part about first housing savings account, the amount 17,500 that you accumulate will be completely tax free. You don't have to pay any taxes on the interest you have earned. Second thing, in total, you're putting $450, right? Plus you're putting $500 in one time. Okay, so in total, you're putting $15,349, right, in your kitty. 15,349, not that. Okay, you have to subtract it. Signs are important. So you're in total putting $16,349 in your first housing savings account. How? 500 one time and 440 per month. Okay, now this 16,349 will give you some tax back. It will generate some tax refunds. It is like RRSP and it generates some tax refunds. So if your tax rate is 15%, it will generate a tax refund of $2,400, right? That you can again use for down payment. So by doing this, by investing $500 one time and $440 like monthly, you can generate almost $20,000 that you can use towards down payment. Your target was 17.5. You accumulated that, but you also got some tax back that generated some additional amount. That is why first housing savings account is a great vehicle to invest or to accumulate your down payment. It combines the best of both worlds of tax-free savings and RRSPs. You should seriously look into it. I will share a link of first housing savings account in the description. Okay. So that was about down payment. Then you might have a goal to travel. So this is a mental model that I use for travel. Do not travel on your credit cards. So you should start saving your money, right? So you can use cash.to kind of ETF, like safe, pays you interest, right? And short-term goals, you shouldn't take too much risk. So save money, put it in your tax-free savings account, right? Then once you have accumulated enough money that you have budgeted, then use credit cards. Why should you use credit cards? You get points when you book tickets, when you do expenses, etc., etc. But important point, use this money in your TFSA that you have accumulated for travel and pay off the credit cards right away. Do not, especially when you're young, do not let your debt get out of hand, because it's very important to, right, have good debt management habits. So save up, Use credit cards, no issues with that. You get points and stuff, you build credit history, but pay those credit cards off right away. Now, lot of young people do not think about retirement, but you should start thinking. And there is a reason for doing that. Because why you should start thinking early about retirement. This is the math, right? So if you invest $100 per month starting from the age of 20, by the time you retire at 65, you will have 530,000, okay, at 8% interest. If you delay that decision and you start investing in your 30s, right, then at 8% interest you will only have half of that, almost 230,000. So the more you delay, right, starting investing for retirement, the lower amount you will have, right? And if you delay even that, if you start in your 40s instead of your 30s and invest $100 per month towards your retirement, by the time you retire, you will have only $95,000, which is a huge difference. There is a concept of time value of money. Time is a very important asset that you have when you are young. The earlier you start investing, the larger impact you will have on your retirement. So it's very important to start thinking about it. I'll show you the math in the Google Sheet more, but it's very important to start early. I'm again telling you from like the deepest part of my heart, if you can start early, you're going to make the largest bang for your buck. Okay, the more time you give to your investments, the higher they grow. Now, where should you accumulate your retirement funds? So you can use your tax-free savings account, and then you can use your registered retirement savings plans. There are benefits of using tax-free savings account. There are benefits of using RRSPs. It depends on the situation. I have videos on them. I will be linking them in the description. Now, where should you invest? So when you're building for your retirement funds, you should start investing in an index fund, right? That's the best place to start. Maybe a balance fund, so that has both stocks and bonds in it. You can also start using REITs and other instruments to start saving for retirement. Okay, I have a lot of videos on index funds, ETFs, etc. Right? So subscribe to the channel or something, or if you want, like, there is a course on Udemy that I do. There are exclusive videos that I only post on Udemy. I do not post it on YouTube. So if you want, you can check the description for that. So let's look at the Google Sheet and understand. Okay, so retirement planning sheet. So this math is very important. If you start investing $100 per month at the age of 20 and your retirement age is 65, you will have $530,000 in your kitty, a decent amount of funds by only investing $100 per month. If you start investing in your 30s, right, $100, you will only have 230,000. And this is an important math. Now, if you're starting in your 30s and want to accumulate same amount as 530,000, right, then you would have to put $229 per month instead of 100. So you would need almost 2.2 times the monthly amount that you need to accumulate retirement funds as in your 20s, in your 30s. So that if you delay your decision, or if you delay thinking about retirement for a decade, you will have to start investing twice that you would have needed in your 20s. Now, if you delay it even more, even a decade further, in your 40s, you were busy with other things in life, you didn't plan for retirement, and you start planning in your 40s. If you invest $100, you will only get $95,000 in your retirement. So you will have to invest significantly more. You will have to invest $544,000 to achieve 530, that you could easily would have achieved it if you started with $100, right, in your 20s. So the earlier you start, even if you have $50, $100 per month that you can allocate to retirement, start doing that. Even if it is $20, $10, doesn't matter. Whatever surplus you have a tax-free savings account, registered retirement savings plan, put it in that, invested. There are well simple platforms that automate investments. You don't even have to think about what to buy, right, and what to do. So look into those platforms, and important point, start early. Okay, so that's it in this class. See you in the next one.